All right, if you've been watching the metals market this morning, you already feel it. Silver is dumping again. I'm talking about a market that already suffered a historic 34% crash, and instead of stabilizing, it's hovering near that $80 to $82 zone like a boxer trying to stay upright after a knockout. So what's actually going on here? Because the real trigger isn't what most headlines are telling you. Stay with me, because I'm going to show you why this drop matters far beyond silver, and more importantly, how you can recognize this exact setup the next time it starts forming in any asset you follow. If you're watching this right now, you're ahead of the noise. Your job is to understand the mechanics underneath the move, not just react to the price. Before I explain what caused this, let me teach you something most investors learn the hard way. Safe haven trades don't usually fail slowly. They snap. Think of crowded trades like a theater that quietly filled up during a storm. Everyone rushed inside for protection, but the moment the weather clears, nobody leaves politely. They all sprint for the same exit. Prices don't drift lower in that environment. They air pocket. Here's what you need to know about markets. They're forward-looking machines. Silver didn't just rally because people loved the metal. It rallied because investors were pricing in fear, geopolitical risk, loose monetary policy, currency uncertainty. But once expectations change, even slightly, the price has to reprice fast. And that repricing isn't gradual. Ask yourself this: are you watching the asset itself, or are you watching the expectations underneath it? Because that distinction will save you thousands. If this is making sense, drop a comment below and let me know what you're watching in your own portfolio. I actually read these. Now here's what's actually happening. The primary driver is a sudden shift in U.S. monetary expectations after President Trump nominated Kevin Warsh as Fed chair. Markets interpret Warsh as disciplined, less tolerant of easy money, and more focused on inflation credibility. Translation: higher real rates could stick around longer than traders hoped. Silver hates that. Unlike yield-bearing assets, silver just sits there. It doesn't pay dividends. It doesn't generate income. So, when interest rates look structurally higher, the opportunity cost of holding it rises instantly. You could be earning 4 or 5% in bonds, or you could be holding metal that might appreciate. Maybe. The math changes fast. And when the math changes, the positioning has to change. That's not opinion. That's mechanics. When Warsh's name hit the wires, you could see the repricing start in real time. Real yields ticked up, the dollar firmed, and precious metals rolled over. It wasn't complicated. It was cause and effect. But that's only the first domino. Secondary confirmation came from easing geopolitical tension, particularly renewed U.S.-Iran talks. When global risk cools, the urgency to hide in safe havens fades. You don't need the storm shelter if the sky is clearing. And we've seen signs that some of the tension that drove people into metals in the first place is starting to ease. Not disappear. Ease. That's enough. Because markets don't wait for certainty. They move on probability shifts. So you've got tighter policy expectations on one side and declining fear on the other. Now combine those two forces. That's when markets move violently. Both macro pillars supporting the rally start cracking at once. That's convergence. And convergence is where the real damage happens. Because it's not just one narrative failing, it's two confirming each other. When that happens, confidence breaks fast. But here's the part that should make you pay attention. The mechanical side of the market is now amplifying the move. Higher volatility triggered increased margin requirements in futures markets. So leveraged traders suddenly needed more cash to hold the same positions. What happens if they don't have it? Forced selling, automatic liquidation, no emotion, just math. Exchanges raise margin. Accounts get flagged. Positions get closed. It doesn't matter if the trader still believes in the thesis. The system forces the exit. So when the initial crash hit, it wasn't the end. It was the ignition. Let me break down the sequence you should memorize, Because this pattern shows up everywhere. Policy repricing starts the decline. Volatility spikes. Margin calls follow. Leveraged players unwind, liquidity thins, and prices overshoot every time. You saw this in crypto in 22. You saw it in oil during COVID. You're seeing it now in silver. The playbook doesn't change. The asset does. Now let me show you what most people are missing. The sell-off may already be transitioning from panic into something more structural. Panic is emotional. It's sharp, violent, irrational. Structural moves are slower, heavier, and they often last longer than you expect. And that should make you pay attention. Because if this is structural, the bounce you're hoping for might not come as quickly as you think. Structural shifts mean the underlying reasons to own the asset have changed, not just the sentiment. And when fundamentals shift, prices can grind for months. You don't get the V-shaped recovery. You get consolidation. You get reaccumulation. You get time. This is the exact same playbook that showed up in 2013 during the taper tantrum. Precious metals collapsed once markets realized easy money wouldn't last forever. Gold dropped from 1,700 down to 1,200 in less than 3 years. Silver got cut in half. Why? Because the Fed signaled they were going to start pulling back. The expectation of endless liquidity died, and metals, which had been priced for perpetual easing, had to reset. Zoom out further and you see echoes of 2008's post-crisis rebound. Metals surged on fear, then retraced sharply once policy direction stabilized. Even 1980 tells a version of this story. Silver exploded during inflation panic, hit $50 an ounce, then cratered when Paul Volcker restored monetary credibility. It fell below $5 within 2 years. When you look at the pattern, it becomes clear. Metals don't just trade on inflation. They trade on trust. Trust in policy. Trust in stability. Trust in the future. And when trust in policy returns, the panic bid disappears. Now, let me be skeptical for a moment, because I want you to hear independent thinking, not just hype. Could this be wrong? Absolutely. Markets love humiliating consensus views. If geopolitical tensions flare again, or if growth suddenly weakens, safe haven demand could reappear fast. Silver is notorious for violent reversals. It's one of the most volatile major commodities. So yes, this could reverse on a dime if the narrative shifts back. And yes, you'll hear manipulation theories. You always do after sharp drops. The blogs will light up, the comment sections will explode. But here's the thing. You don't need a conspiracy to explain a crowded trade unwinding under tighter financial conditions. Occam's razor applies. The simplest explanation is usually correct. People bought silver expecting chaos and easy money forever. Chaos cooled, money got tighter, they sold, that's it. Focus on what you can control. Recognizing when positioning gets extreme, understanding when narratives change, managing your own risk, that's your edge. There are probably 3 types of people watching this right now. Some of you bought the rally and you're feeling that pit in your stomach. Totally understandable. Losses feel personal. You got in at 100, maybe 110, and now you're watching it drift toward 80. That hurts. But ask yourself, did the reason you bought still exist? If you bought because you thought rates were going to zero forever, that thesis is being challenged right now. If you bought because of war risk, check if that risk has actually changed or just cooled. Discipline matters more than hope. Hope is not a strategy. If the thesis broke, accept it and move on. If the thesis is intact but timing was off, then you've got a different decision to make. But be honest with yourself. Others of you are waiting for the dip. You're thinking, is this my entry? You watched it run to 130 and didn't chase. Now it's back near 80 and you're wondering if this is the gift. Patience is your edge here. Let the volatility compress. Markets rarely bottom when they're still chaotic. You want to see stabilization first. You want to see selling exhaustion. You want to see some time pass where it's just boring. That's usually where the best entries hide, not in the middle of the storm, after it. And then there are the pattern watchers, the ones studying flows, policy signals, positioning data. If that's you, this is your classroom moment. You're not reacting. You're learning the fingerprints of a crowded unwind. You're taking notes on how safe haven trades collapse when expectations reverse. You're watching how margin mechanics amplify moves. You'll use this the next time you see a parabolic move in anything: gold, tech stocks, crypto, whatever. The asset changes. The pattern doesn't. So here's what I want you to answer in the comments. Which type are you? And what's your biggest takeaway from watching this unfold? Here's the universal principle that applies to everyone. Don't chase safety when it feels safest. The time to buy safe havens is when nobody wants them, not when everyone's piling in. By the time silver hit 130, it wasn't a safe haven trade anymore. It was a momentum trade. And momentum trades end badly when the momentum stops. That's not hindsight. That's structure. Here's where I stand. I'm not outright bearish on silver long-term, but I'm definitely cautious in the near term. Let me tell you what I'm personally watching. First, I'm watching real interest rates. If they keep climbing, pressure on metals likely persists. Real rates are the opportunity cost of holding non-yielding assets. When they go up, metals usually go down. It's one of the most reliable inverse correlations in markets. Second, I'm watching volatility itself. When volatility compresses and stays compressed for a few weeks, that often precedes durable bottoms. Right now, we're still in high vol mode. That means the selling probably isn't done. Third, I'm monitoring geopolitical tone. Fear can return faster than models predict. If we get another flare-up in the Middle East or unexpected escalation somewhere else, that could bring safe haven flows back quickly. But I'm not positioning for that. I'm acknowledging it as a risk to the current view. Based on my analysis, this drop wasn't random. It was mechanical. Expectations shifted around policy. Leverage cracked under margin pressure, and the market repriced violently. That's not a conspiracy. That's structure. The fundamental case for precious metals over the long term hasn't disappeared. Debt levels are still historic. Currency debasement is still a risk. Geopolitical instability is still real. But the timing narrative just changed. And in markets, timing is everything. You can be right about the destination and still lose money if your timing is off. If history rhymes, and I think it does, silver may need time to consolidate, time to reset positioning, time to rebuild conviction. That process doesn't happen in a week. It happens over months. The 2013 example took years to fully play out. I'm not saying this will take years. I'm saying don't expect a quick snapback just because it fell fast. Fast drops can lead to slow recoveries, especially when the underlying narrative has shifted. I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I've said. Check the data yourself. Build your own thesis. But use this as a framework. Use this as a way to think about crowded trades, about how expectations drive price, about how leverage amplifies moves, because this pattern will show up again. Maybe not in silver, maybe in something you're not even watching yet, but when it does, you'll recognize it, and that recognition is worth more than any single trade. If you made it this far, you're the kind of person who thinks critically and doesn't just react to headlines. That mentality will serve you well. It'll keep you out of traps. It'll help you spot opportunities others miss. It'll give you edge in a world where most people just chase price. So, do me a favor. If this helped you see the situation more clearly, share it with someone who needs to hear it. Hit subscribe if you want more breakdowns like this. And drop a comment with your biggest takeaway because I genuinely want to know what's clicking for you. Stay sharp out there. Watch expectations, not just headlines. Think critically, verify data, and make your own decisions. I'll see you in the next one.